Today, Governing Council held the policy interest rate at 2.75%. This decision reflects three main considerations. First, uncertainty about U.S. tariffs on Canada is still high. Discussions between Canada and the United States are ongoing, and U.S. policy remains unpredictable. Second, while U.S. tariffs are disrupting trade, so far Canada's economy is showing some resilience. And third, inflation is close to our 2% target, but we see evidence of underlying inflation pressures. There's also uncertainty about how businesses and individuals in Canada and the United States will adapt to this new trade environment. The increases we've seen in U.S. effective tariff rates are less than what was threatened, but they are still outside post-war historical experience. Some tariff agreements have been negotiated between the United States and its trading partners, and that has reduced the risk of a severe and escalating global trade war. Unfortunately, the tariffs in those agreements also suggest the United States is not returning to open trade. So far, the global economic consequences of U.S. trade policy have been less severe than feared. U.S. tariffs have disrupted trade in major economies, and this is slowing global growth, but less than many anticipated. While growth in the U.S. economy looks to be moderating, the labor market has remained solid. And in China, lower exports to the United States have largely been replaced with stronger exports to other countries. In Canada, we had robust growth in the first quarter of 2025, mostly because firms were rushing to get ahead of tariffs. In the second quarter, the economy looks to have contracted as exports to the United States have fallen sharply, both as payback for the pull forward and because tariffs are dampening U.S. demand for our goods. Growth in spending by Canadian businesses and households is being restrained by uncertainty, and new U.S. tariffs are having profound impacts on directly affected sectors. A number of economic indicators suggest that excess supply in the economy has increased since January. Nevertheless, the Canadian economy is showing some resilience so far. A number of surveys suggest consumer and business sentiment is still low, but it has improved. And in the labor market, we're seeing job losses in the sectors that rely on U.S. trade, but employment has kept growing in other parts of the economy. U.S. tariffs are having a profound impact on the sectors they've been directly applied on. So, steel and aluminum, 50% tariff, having a very direct, severe effect. When we say the economy is showing some resilience overall, what we're saying is that when you look beyond the directly affected trade-sensitive sectors and you look at the rest of the economy, it is continuing to grow. If you look at employment outside of sectors heavily dependent on U.S., employment in the rest of the economy has continued to expand. As I mentioned in a previous question, consumption growth is modest, but it is continuing to grow. So, look, the economy is weaker, but it's not sharply weaker. It is showing some resilience so far. We will be watching closely what happens. Part of that is going to depend what happens with tariffs themselves, and that's why we produced these three scenarios. Hopefully we move more towards a de-escalation scenario, and we get a stronger bounce back in growth than we have than is in the current tariff scenario. But we've got to be alive to the possibility that that's not the only possible outcome. And really, to getting to that forward-looking statement, if those spillovers are bigger and there's more downward pressure on inflation and the upward pressure from tariffs and trade disruption are contained, there may be a need to cut interest rates further.